Well, welcome to today's webinar, What Today's Headlines Means to Today's Investors. We're happy to have you with us, and we're happy to welcome Apollo Lupescu. Apollo is an experienced PhD in economics at Dimensional Fund Advisors, a premier global investment manager with about $1 trillion in assets under management. Known for his ability to translate complex investment concepts into clear, accessible language, Apollo has earned the nickname Secretary of Explaining Stuff. He's a globally recognized speaker who's delivered hundreds of lectures and town hall events to financial professionals and individual investors on various investment and market-related topics. Apollo brings more than 2 decades of experience at Dimensional, where he applies the analytical rigor developed during his earlier career teaching at the University of California. He holds a PhD in economics and finance from USC Santa Barbara and a BA in economics from Michigan State University, go Green, where he competed in and coached water polo. These days, when he's not helping clients navigate market volatility, you might find him navigating actual waves in the ocean as surfing is a new challenge for him. Welcome, Apollo, and thanks for being with us again. Last time it was pre-COVID when you visited our office, so it's nice to
Right.
see
Hey,
you.
Steve, great to see you. Thank you so much for the invitation. And fun enough, just not too long ago, I pulled out my favorite hat, which does happen to be the Michigan State water polo, which is still with me 25 years later. So it's always great fun to talk to you and folks in Michigan. I still have a great affinity for that state. I love it.
Well, today's not about predicting the market, and it's about how to behave inside of them. And it does seem like geopolitics is dominating the news cycle right now. So maybe we should begin with that, if you think that's a good place to begin.
Yeah, absolutely, because there's so much going on, and before we get into the market aspects and the financial aspects of this situation in the Middle East and the Iran war, it's probably worthwhile taking a step back and acknowledging that there's a human element to this. And it's real. And there are U.S. soldiers who are deployed and they're in harm's way. You read in the press that there's a civilization that's going to die within a day, and this is really emotional, and this touch like really our deeply held beliefs, our core identity as individuals, and I think we need to start there by acknowledging the suffering that is pretty much whatever side you're on is just this is horrific, and what I mean by whatever side you're on is like if you're the Iranian people who were subjugated by their government, and or you're the U.S. soldier who's in harm ways. I mean that's real, and it's painful to see those images. And Steve, the reason I want to start there is because those emotions are what make us human, and they're perfectly fine to have. I'm not ashamed of those. I have those as well. What I've learned over the years is that when it comes to investing, the really successful investors are able to acknowledge the emotions and at the same time take a step back and be very pragmatic in the way that they make decisions about their money. And they don't make these decisions based on how they feel and those emotions, but rather something that is much more, as I say, pragmatic, rooted in data and evidence, like we know how things actually work in terms of finance. And in that respect, I have to start with just the fundamental principle around the stock market. When you buy a share of Ford, of GM, of Coca-Cola, you name it, you become part owner into that business. And what the stock market is trying to assess every single day, well, how much should one pay to get ownership into a business? And what the market's fundamentally asking with this war and when it started is how is this event impacting the opportunities of companies to make money? Because ultimately the value of any business comes from that. So it is a cold hard question. So it's not about morality, but it's the pragmatic question of what's the impact of a bit on a business that this geopolitical conflict creates. And when the bombing of Tehran happened on Saturday, when the market opened on Monday, what you saw is a company, for example, a U.S. airline that has a lot of flights in the Middle East that were canceled. Well, that's a negative impact, and you saw perhaps that stock dropping by 3-4% that day. At the same time, a U.S. defense contractor who was likely to have to produce more munitions or radars, whatever, that stock popped up by 3-4%. So the same geopolitical conflict had different outcomes to different companies based on the impact of on their bottom line, and not just this year, but for years down the road. And in that respect, if you look on that Monday across the entire U.S. stock market, what you saw is that it was very flat. It didn't move much, and it's not because market participants were asleep. They just woke up on Monday. Well, there was a bombing over the weekend. No, they knew everything was very clear. It's just based on everything we knew on Monday, the impact on U.S. companies was relatively muted based on what we knew on Monday. Coca-Cola, Nvidia, Facebook, Google, how much will their earnings be impacted by the bombing of Iran? I'm not sure, but I don't think, Apple sells so many new iPhones in the country. I'm not sure how many Starbucks are on there. So that's what the market reflected, flat, not because of the morality, but really because the bottom line impact to many companies was muted. Now, by a few days later, what happened is that Iran's strategy emerged, which is unknown at the beginning, and that was to shut down this Strait of Hormuz. And now everybody's a geography expert. And when that happened, obviously the consequence of that is that about a fifth of all world's oil could not pass through there. So now you have a situation where there's a huge problem because there's not enough oil. 20%, a fifth of the world oil is not available, and that will create problems. And the biggest problem is perhaps oil price would go up, and that's exactly what happened. And that did have implications for a company like McDonald's, for example, because if people have to spend more money on gas, maybe they won't have money to go buy the Happy Meal. And that's why you saw a lot of the firms drop. So for the third month of this year, for March, which is the full month of conflict, the U.S. stock market was down roughly about 5%, which is a signal that, yeah, it's not pleasant, but it's really not that tremendously horrific. And in fact, what's even more interesting, folks, and this is kind of like a quick note, Steve, when you measure the U.S. stock market, you look at for example, the largest 500 stocks in the U.S. market, and for the first 3 months, it was down about 4.3%. And it was pretty even after the first 2 months, and then the month March was the day that the month that it dropped. But the way you measure performance, you look at the underlying results of any individual stock. But there's one other thing that matters: the size of a company. So when you look at the size of the company in the U.S. market, these magnificent 7 companies that you hear so much about, Nvidia, Microsoft, Apple, Facebook, Amazon, Google, and Tesla, they're not only large and important when it comes to technology and so forth, but they are also very impactful to the market, because the market was down about 4.3% for the quarter, and yet on average, these 7 companies for the same quarter, they're not down 4.3, but a significant bigger drop, 11.3 down. And they left a hole in the S&P. So if you look at the remaining performance of all the other stocks in the U.S. market, the S&P 500 minus these 7, the S&P 493, their performance was pretty much even. It was like negative 0.7. So the reason I bring this up, Steve, is that, again, when you look at the impact of this war, the signal of the market is that perhaps, what's going on there, it's completely emotional. But when it comes to the ability of U.S. companies to make money, that might not be the primary driver why the market moved. Because I don't believe that Nvidia or Apple or Microsoft, they're so tied into the Middle East and oil for which is one of the results of that. So the first point here is that when you look at the data, we don't see that particular event had a huge impact on the U.S. market, because a lot of these U.S. companies are likely not going to be as impacted, particularly if the price of oil does not stay high for very long. The second point to make is that when a situation like this happens, what we see over and over is that there's a human ingenuity and there's a resilience that people have, which translates into companies being resilient, markets being resilient, and countries being resilient. In other words, when faced with these unprecedented challenges, quite often we do see that companies and countries, they do rise to the occasion. And quite often at the back end, they might emerge stronger. You look at the pandemic, it was a horrific time. And at the end, like, companies didn't fold. They just basically how do we navigate these times, and maybe came out stronger. But if you look at the oil crisis, because a lot of folks are pointing to the oil crisis, I want to remind folks that the big oil crisis, the first big oil crisis that the country experienced was in 1973-74, when OPEC, Organization of Petroleum Exporting Countries, decided not to send oil to the US. And at the time, we didn't produce a lot of oil at home, pretty much very little at the time. And the result of that was this: there was no gas. There was no gas at any price. Why? Because the government capped the price of gas. It went from 40 cents to 50 cents a gallon, and it couldn't go any higher. So it wasn't, price was not being used as a rationing mechanism. And imagine that you're in this line, and you're all the way to the back, and you're sitting there for hours and maybe days, and you kind of, wow, this is the end of the world. This is as bad as I've seen. And it was absolutely terrible. It was terrifying. I'm not sure if you or your parents might remember something like that. But what emerged out of that is the idea of energy independence. And 50 years later, the US is now energy independent. We produce more oil at home than we need. We export oil, we export natural gas, but it all started with that crisis. So it's quite possible that you're going to have a situation where this crisis might lead to actual some positives down the road, even though somehow feels right now so negative. The third point that I want to make is that I've heard enough investors say, well, we need to do something. Like the world's falling apart, the wheels are coming, like we need to do something. And you have to be very careful with that reasoning, because quite often that is an emotional response, not a pragmatic one. And most often when people say we need to do something, it means like, well, I don't like the risk. I don't like where this is going. Let's sell. And when you do that, it turns out that it's not really the best way to go. Because again, it's an emotion response. So this idea of we need to do something about it, it's a legitimate question. What I would argue though is that if you see the market dropping, which it has dropped, instead of selling in panic, a better strategy would be to have a system in place to know what adjustments do you make when the market moves. And what advisors do, and what Jim does, for example, is that if they need to have a balance, for example, between stocks and bonds, which are ownership or lending, different type of investment strategies, and stocks drop, which is the ownership piece. Instead of selling more in panic, what they could do is trim some of the gains from bonds and then buy and replenish the stock portion. That means that you're taking some chips off the table, you buy something that now has a better value. That process is called rebalancing. So when you think about what do we do now as investors, the better strategy is to rebalance rather than selling panic. Which leads me to the fourth point, Steve, and I'll kind of wrap it up with this. Um, it's been so interesting because I've heard enough folks saying, I'm losing so much, this is terrible. I have to say, quite often I keep wondering, what if this whole geopolitical event, and one might come next, will have no significant impact on your ability to retire, or to ability to generate income in retirement, or your future plans. What if that's the case? And how can that be? Well, it turns out that probably the most important element in investing is not predicting when something happens or what's the news, but rather having a plan. And that's what Jim delivers to you. You have a plan, and the plan takes account of your needs. When you need the money, how much money do you need? It takes account of your assets, your working years. It takes account of your risk capacity. And ultimately, it builds perhaps some reserves that at some point, if you need some money, you don't need to go sell the falling stocks. And that's part of what makes it so interesting. You don't need to predict, you just need to plan. And to me, the really obvious part is that even as I lived in Michigan, and now I live in LA, and the one thing I know it's going to happen here where I live in Southern California is an earthquake. I'm under no illusion that I'll live my whole life without seeing an earthquake. At some point, there'll be an earthquake, and it's not about predicting the earthquake, but rather what do you do to prepare for that? And in my case, I bolted the house to foundation. I have water in the trunk. I tied the shelves to the wall. I did the things that I could do to make sure that I'm prepared for when the day comes. And when it comes, it might not be pleasant, but it won't be devastating because I prepared. So to me, even if you look at your accounts right now, if you look at a portfolio that is balanced between stocks and bonds for the first quarter, it's pretty much flat. You're not going to see tremendous losses at all, even though mentally you might think that's the case. So, again, it's all about not overreacting to news, being pragmatic, and letting that plan that Jim created for you just do its thing.
Well, thank you. That was a fantastic discussion about the what's affecting the world at large right now and the war in Iran. Let's move to what would be the topic if it wasn't for Iran, tariffs. I think there's a lot
Yes.
of misunderstanding about tariffs right now.
Right. Yeah, so tariffs are, I mean, to begin with, it's a very interesting topic. And I remember when I first took my first econ class at Michigan State, I heard tariffs, 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 and I didn't really understand what they were. I ended up reading the textbook, but even after reading the textbook, it wasn't exactly clear. So, it is a bit of economic jargon. So why don't I start by kind of maybe relating tariffs to everyday life and kind of how I would explain this in a in a cleaner way, and I'm going to use just to illustrate the point something that is near and dear to my heart, and that is maple syrup. I love maple syrup. I'm not Buddy the Elf, but I put in a lot of things, maybe not spaghetti, and I get my maple syrup at Costco. So let's illustrate the idea of tariffs with this particular item. So Costco would like to sell maple syrup, so it goes to Vermont producers and asks them, "Hey, can I buy you maple syrup?" And they say, "Sure, take it." It turns out there are a lot of people like me who love maple syrup, and there are not enough trees in Vermont, but rather there are a lot more on the other side of the border in Canada. So Costco also goes to those Canadian producers and asks them, "Hey, friendly Canadian producer, can I buy your maple syrup? And I will, let's say, pay you $20 a bucket." And those Canadian producers say, "Sure, I'll sell it to you for $20 a bucket." And then Costco has to add a few dollars for the warehouse, the employees, their profit margin. And let's say they add another $5. So I can go pick it up for $25. Five for Costco, 20 for the producer. And that's in the good old days with no tariffs. And now President Trump comes along and says, no, 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 no. We're going to impose a 25% tariff on everything that comes from Canada. And let's say that maple syrup is included. Well, how does it work now? The company, the entity legally responsible for sending the government a check in the value of 25% of the value of what's being brought in the US is Costco, the importing company. So if they bring in $20 worth of maple syrup, 25% of that is $5. So they have to send the government immediately a check for $5, even before they sell that. So where is this $5 going to come from? Well, option one is they go to the producer and say, "Hey, listen, friendly Canadian producer, the government wants me to send them $5. Why don't you lower your price to $15? So by the time I send the $5, nothing changes for our consumers." What do you think those producers are going to say? No chance. I'm not doing it. It costs me more to make it. And not only that, but where else are you going to get maple syrup? No, take it or leave it. It's $20. And Costco has absolutely no recourse to force the producer to lower the price. And they say, "Okay, well, I have nowhere to get it. I'll pay the $20. So option two is that Costco takes their own $5 and they send that to the government. But if they do that, it's not a feasible business. You can't keep running the business like this. So option three is to increase the price, take the additional dollars, and send that to the government. So when it comes to tariffs, there are three parties involved: the producers, the importing company, and the consumers. And even though legally it's the importing company that's supposed to pay the tariff, who actually ends up paying, it's not clear at all. It depends from product to product. And what we know is that in the latest tariffs, when President Trump imposed those, for the past year or so, the Fed has done research, and what they found is that 90% of the tariffs were passed were paid by U.S. importing companies and U.S. consumers. Foreign producers paid 10% of the tariff. So there was a bit of like 10% coming from the producers, but 90% were paid by businesses who imported and consumers. Now, again, it's hard to disentangle which one is which, but the evidence, at least so far, it indicates that companies have been reluctant to pass a lot of that tariff to consumers. I think Ford and GM, they took some huge losses because of the tariffs that they paid. So it has burdened more firms and consumers than importers. And it's quite possible that firms might decide to start passing more of that cost to consumers. And that's why you might see some prices rise. But it really depends on product by product. But what I want you to know is that ultimately somebody has to pay this tariff. And so far the evidence is that it's not the foreign producers, but it's either the companies importing from the US or the consumers. Now, what's the impact of that on the stock market? It's been interesting because last year we had tariffs in the U.S. And if you look at the performance of the U.S. market with these tariffs, what you see is that the U.S. Market was up about 17%, 16.8 to be precise, and that's across the large companies, small companies. So across the board, the U.S. market did well. And in fact, the long-term average is 10%. So Steve, this did twice as well as the not twice as well, but like quite significantly better than the long-term market average. Now, the thing is, we are the ones imposing the tariff. We are the ones who are, supposedly hurting other folks. So how did our trading partners do? Because perhaps one of the strategies might be, let's put more money in the U.S. because now we have some advantage, whereas these foreign producers and foreign markets might actually be at a disadvantage now. So let's take the largest three trading partners of the US, and let's start with China. And China at some point had tariffs of 145%, which in my opinion might as well be 599% because it's a joke. Like once you get past a certain point, it just doesn't matter. But they dealt with super high tariffs. And what you saw is that the Chinese stock market did not go up by 17% or so, but rather 31.5, significantly outperforming the US market, despite being the target of such high tariffs. And then you look at Canada. Canada, right there in the north, our friends with maple syrup, their stock market, so dependent on exporting to the US, did not go up by 16 or 31, but rather 38%, more than twice the performance of the US stock market. And we also picked the trade fight with our friends to South, Mexico, and their stock market, again, didn't go up by 31 or 38, but rather a whopping 54%. So what's the story here? How do you interpret these results? And to me, there are a couple of things that jump to mind. Number one is that, tariffs are one of the many, 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 many variables that drive the performance of the stock market, but it doesn't appear to be a primary one. It's one of the many variables that might drive the results in the market. And because of that, one should not trade solely because of tariffs. It's just not the primary driver. But I think more fundamentally, economically, what it also says is two other things. One is that the same way that we talked about navigating uncertain times with the geopolitical risk, if companies are faced with these uncertainties around tariffs, well, if I'm not going to produce in China, like Apple decided, well, instead, let's move production from China to India or Vietnam or some other country, you're still going to make it somewhere else, not necessarily in the US. It just might not be China, for example. But the other big one that I think it's relevant is that what the U.S. is about 5% or so of the global population and land mass, roughly speaking, but 25% of the global economy. So it's the largest economy in the world. At the same time, you can look at it the other way. 75% of the world economy is outside of the US. And what they have said is basically, great, if you guys want to build a moat, build a tower and a castle and not trade with anybody else, knock yourself out, trade among yourselves. That's fine. But the rest of the world is still open for trade. They're still going to trade with each other, and 75% of the global economy is outside of the US. You don't want to participate? Fine, we'll do it. And I think that's that's an interesting thing because trade has benefited the U.S. by and large, not every segment of the population, not everybody. And the question is, if you look down the road, is it possible that in a way, Canadian stuff is going to go to Europe and German cars might go more to Asia than the U.S.? It's possible. And maybe there's a benefit to this or not. We don't know yet. What I can tell you right now is that if we don't want to trade, that doesn't mean that the rest of the world, which is 75% of the global economy, won't. And we've seen a lot of trade agreements that just simply don't include the US because we have been more restrictive of trade. And it's too early to tell economically what the impact is, but I can tell you as an investor, it still makes sense to be globally diversified because the U.S. companies are still amazing. It also might happen that a lot of global companies are going to be, doing just fine, not selling to the U.S.
Well, this isn't on our agenda, but could you talk about the home country bias for a minute?
Yeah. So as I said, what's fascinating is if you look at the U.S. Stock market, the U.S. economy, it's about 25% of the global economy. But there's another way to look at it as an investor, which is what is the combined value of all the companies that he can buy and sell in any one country? And if you redraw a world map and instead of using landmass, you plot the value of all companies that investors can access, all companies that can be bought and sold on stock markets in each country, this is what that map will look like. The US, even though it's 25% of the global economy, it is 65%, two-thirds of the value of all companies that you can buy and sell. And it starts with these magnificent seven, the Google, the Amazon, and so forth. But it also goes into Shake Shack and McDonald's and you name it, all these companies that there are about 3,000 of them that he can buy and sell as an investor in the US. So we are by far the largest stock market and a lot bigger in a way than the economy. And it's got to make sense because Google's being used by hundreds of millions of people. We go around the world, everybody has an iPhone in their hands or use an Android, which is a system that's operated by Google. Facebook has 1 billion users. So that's the reason that the US is such a big part of the global market is because these companies, US companies are just gigantic and used around the world. Now, if you go outside of the world, what you see is that, for example, Canada, even though landmass is great, in terms of value of companies, is not as much. They have some, natural resources and they have some banks, but not really significant. The second largest stock market happens to be Japan. But around the world, there are 40 different stock markets or so, and among them, there are about 10,000 companies in which you can buy ownership. So one of the decisions that investors have to make is how much money do I put in each one of these stock markets? And what it means if I had $100 to invest, let's just say simply $100 to invest, you can buy proportional to the value. So what it would mean is that I would invest $65 in the US. I would invest $5 in I would invest $5 in Japan. I would invest only $3 in China because they're not the companies there. They're available to U.S. investors and not significant in terms of their size. And then that would be what's called market cap weighted. In other words, the way the percentage that you would put would be based on those values. And that's one way that you can approach this problem. Now, what Steve asked about is this idea of home bias. So the idea of home bias is that, okay, well, because we live in the U.S. and because, we use dollars and because maybe some tax reasons, what if instead of 65%, we emphasize and maybe we buy $70 in the US, which would leave only $30 outside of the US and 30 instead of $35. So this idea of home bias is: do you want to use these percentages as a starting point and go with those, or do you want to emphasize the U.S. more? And I have to say, there's a bit of an art and a science to this. When Steve and the Gen team, when they build the portfolios, they really pay attention to this and they're very careful in terms of how they allocate the percentages that go into each market. But that's what home bias basically means. Do you want to emphasize more the U.S. market because we are in the U.S., or do you want to keep it sort of neutral and in line with the percentages relative to global capitalization?
Perfect. Well, we've talked about geography and economics. Now let's go to computer science and talk about AI.
Yeah.
The question I had there for you is what did investors get wrong in the late 90s that feels familiar today?
Yeah, it's a really interesting question. And that's what's so interesting about that question is that in the late 90s, I mean, let's go back to early 90s. pretty much like today, there was a revolutionary technology. I don't know about you, Steve, but I found it magical that I go to a computer, I type in a few things, and all of a sudden I could get information that otherwise I had to go to the library
Mhm.
and research. It was magical. Like I was like, whoa, pictures show up on the screen, amazing. And that was the internet. And now, 35 years later, here's another technology that seems magical that you put something in the phone and you can speak in a normal voice. And boy, there's a human-like response, and that's magical. So I think that if you want to draw parallels, both in the 90s with the internet and today, there's this idea of something magical that's going on. And back at the end of the 90s, as Steve pointed out, there was something called the dot-com bust. And people got really freaked out by, whoa, we lost a lot of companies and money, and that's not good. So how do you relate that to what's going on today? Well, let's go back to the 90s and this idea of the internet. And what's remarkable about that, Steve, is that when you're thinking about investing in the internet back in those days, there was no entity called the internet. There was no monolithic investment called the internet, but rather what you had were a bunch of companies. And the way I want you to think about this is they're like horses in a race. And as the race gets started, they're all competing with each other, and it's not really obvious which ones will be the winners. And if I were to take you back in a time machine to the mid 90s and I asked you, okay, not with what you know today, but go back in the mid 90s with that mindset, and I gave you three websites. One website that sells toys for kids, one that sells books for reading, and one that sells pet supplies. And I asked you, hey, Steve, which one will obviously become the future of internet retail? Well, was it obvious that it's the bookseller? Not at all. Not at all. So the first thing I have to say is that as an investor, you have to accept that in order to own Amazon, which is the bookseller, you also need to own eToysandPets.com. And if you hyper focus on the fact that, oh, but eToysandPets.com, they went out of business, you miss the fact that Amazon became Amazon. You miss the fact that the same period, produced Google, which is a money printing machine, that companies that change fundamentally the world and now are their most largest, most successful in human history. And again, if you hyper focus on the companies that went out of business, you miss the forest from the trees. Because that period really generated some of the most amazing successful companies in human history. And that the fact that some companies went out of business, that's not a bug. That's sort of a feature of the market. And we'll talk about this. And to me, we are in a little bit of a similar moment today when people are looking at investing in AI. We're not investing in AI as an entity or a monolithic investment, but rather, again, you have different horses in the race. And at the moment, is it obvious who the winners will be? Not at all. Not at all. The race is just getting started. But we do know that whoever is going to be the winner is just going to, have amazing success down the road. And even if you can fund companies early on and say, well, I want to fund companies early on, you got to be careful because the companies in Silicon Valley, they're called venture funds. And that's like Andreessen Horowitz and Founders and Benchmark and Sequoia, all these famed funds that have backed early on Facebook and Google and eBay and Amazon. All of these companies will roughly do the same thing. When we put money into, let's say, 10 companies that start, we know that roughly about six of them are going to blow through our money, produce nothing, go out of business. We know that two or three are going to chug along, maybe get acquired, nothing really to brag about. And we also know that one or two are the moonshots they're going to make up for everybody else. And I think that private equity logic is now permeating in investing in AI. And what's also really interesting is that it's not really different than the way that the market operates as a whole. Because if you look at the history of the US stock market over the past 100 years, and you look at the beginning of a 20-year cycle, there are roughly about 3,000 companies at the beginning of this 20-year cycle. And what's remarkable is that at the end of this 20-year cycle, roughly about 60% of the companies disappear. They're no longer part of the market. Only 40% of companies in the US market over the past 100 years have survived a 20-year cycle, which is amazing to think that 60% just don't exist there at that point. And out of those that survived, only about 18% actually outperformed the market. In other words, if you look at the at 10 stocks, or 5 stocks, 4 out of the 5 are either going to underperform or they're going to go out of business, and it's only that subset of 18% that does well. So I wish I knew what they were. Everybody's looking for those. We've looked at this. There's no predictable, nothing to predict exactly which ones those are, but it's the same with the market, the same with AI. You have to basically spread your bets. You cannot place any one big bet on a horse because it might not win, and then you're done. And that's been the issue. So I don't look at the 90s as something that was horrifically wrong. It's just the expectations are great about what that technology could do, and the companies that did survive, they absolutely made up for the ones that didn't. But you have to spread your bets. You cannot put any concentrated bets, whether it's on the Magnificent Seven. The best strategy, in my opinion, to protect yourself is to just go around the world, buy as many stocks as possible around the world, and avoid being concentrated into whether AI stocks, whatever type of stock. Just spread your bets as much as you can, because somebody will do well. You just don't know which one there will be.
Thank you. That seems like a good transition into high valuations.
Right.
And the Magnificent Seven, like you mentioned, is down on the quarter, but still up strongly over the past 10 years. So,
Yeah.
so when valuations are as high as they are for growth companies, what changes for long-term investors?
Yeah, that's a great question. So let's demystify the idea of valuation. What exactly is valuation? Because the same as tariff, I do find it's a bit of a jargon. And let's use AI companies, and let's in fact use a company that has bet its future on AI. And I'm referring to Tesla. They announced not too long ago they will stop making their most profitable models, which is Model S and Model X. They're not going to make those anymore because they want to focus on AI. So how do you think about AI and valuations, and what does it actually mean? And at the beginning of the year, if you wanted to buy 1 share of ownership in Tesla, the price to get that share was roughly about $450. So if you had $450, you could, buy yourself a really nice coat, or you can take your spouse to a really, really nice dinner, or you can buy 1 share of ownership in Tesla. So what do you get for that ownership in Tesla? Well, you're not buying hope. You're buying something very tangible. You are now part owner into that business, pretty much like Elon Musk. Not as much as Elon Musk, but you now own a piece of that company. And anytime you own a business, you are entitled to part of the earnings that the company makes, because I'm a part owner into a restaurant, and like, great. I mean, if the restaurant makes money, I make money. It's the same idea. You partake into the earnings of that company. So what were the earnings associated with that 1 share of ownership? Well, when the Tesla share was selling for $450, the earnings associated with that 1 share were $1.50. $1.50. So in that respect, let's reframe this. You just spent $450, and at the current rate of earnings, Tesla comes and puts $1.50 per year into your piggy bank. So at this current level of earnings, the question is, how many years will it take for you to make that initial investment back? You spend $450 and you get $450 and you get $1.50 per year. Well, it's not that complicated. It's about 300 years. That's what valuation is on an intuitive basis. On an intuitive basis is, if you look at the earnings today and how much you paid, how long before you get your money back. That's the intuition. In technical jargon, this is called price earnings ratio. But I wanted to get the intuition. It's a relatively expensive proposition because it's a very long time for you to recoup the initial investment and then be ahead of the game. And to compare with another car company, you can look at, for example, Toyota. Nothing to do with AI. It's all, gasoline hybrid engines. When Tesla was selling for $450, the share of Toyota was less than half, $215 a share. and their earnings were not $1.50, but rather about $20 per share, which meant that your payback period was roughly about 10 years. So this is in a sense what valuation is reflecting on. How much are you paying to get something that I can measure today from an accounting perspective? The question that I got from investors like, why would anybody buy Tesla? It seems like Toyota is a much better deal. And the reason is that Toyota is a pretty steady business, and nobody expects Toyota to just shoot the lights out. They're like, yeah, it's a pretty steady company. But with Tesla, the reason that investors might want to pay so much is because they expect that down the road, maybe not today, but at some point, Tesla is gonna, turn on the money spigot, and it's gonna just make so much in profits that, boy, just you wait. This guy Elon Musk is gonna figure it out, and he's just gonna, the Tesla is gonna roll in dough, and then you're gonna be super happy that at some point you paid 450. So the reason that the price is so high is that there's an expectation that down the road you're going to make fortunes from this company, even though today it might not make money. And that's possible. I mean, I wouldn't bet necessarily against Elon Musk. If 25 years ago, Steve, you had dinner with him and he told you like, I want to build a rocket company. And you told him like, listen, in this history of mankind, only certain governments, not even every government, only certain governments are able to launch a rocket. So what are you talking about building? And it's like, I actually did it. So you got to be a little careful, and maybe that expectation is worthwhile. And maybe that's why you want to own a piece of Tesla, but it is a very expensive proposition. That's what valuations basically mean. And in fact, you can look at all these Magnificent Seven, and if you look at the beginning of the year at their valuations, which is the price earning, the intuition of the break-even period, you do see that Tesla is a bit of an outlier. The long-term market average is in the 20s, and the only company that is in that range is Facebook. And the parent company is called Meta, so that's why it's listed as Meta. And for Google, the parent company is called Alphabet. So if you look at the 20s as being sort of the long-term market average, what you see is Apple, Amazon, Microsoft, and Google, they all have these valuations. They're about 50% higher than the long-term market average, which is the expectation that just you wait till they start really making money. So it's okay to pay a lot for it now, but they will make money down the road. Nvidia is twice the long-term market average because they expect again, the expectations are very great about what they'll produce. And among the seven of them, on average, their price earnings is about 68. But what's fascinating, we talked about the S&P 493. The rest of the stocks in the U.S. market, when you look at their valuation, it's a lot more reasonable. It's very close to a little higher, but closer to the long-term market average, a fraction of the Mag 7. And also within the U.S. stock market, there are not only these large companies in the S&P, but about 2,000 other smaller companies, and the valuation for those companies is a lot more reasonable. It's below the long-term market average. And then within that, there's a small value component, which is, again, from a valuation perspective, is looks a lot better. So not every company in the U.S. is highly valued. The Mag 7 are valued a lot higher because of the expectation that they will make great fortunes, and it's possible. It's just at the moment you have also really good opportunities, and we saw this year. If you look at small companies, they're positive for the year. You look at small value, it's done really well, and that's what a plan would like to have, with not just these Max 7, but really companies around the world and within the U.S. Just be more diversified than just the Max 7 and the S&P 500.
Thank you. I think for our next topic, we'll combine two with talking about market downturn and what to do in a market downturn, with also the value of a financial planner.
Yep.
So let's start there, and I think that's a nice way to spend our last 15 minutes.
Yeah. And let's start with the idea of the market downturn, because earlier in the year, there was a word that got pushed on the news, which is correction. There's a correction in the market. And I want to start by just kind of try to demystify again what do these words mean when you hear correction in the market. So in my lifetime, I'm born in 1969. They have been about 28 different corrections. And the way I look at corrections, they're like the baby bear, the bear cub. It means that the market has dropped by about 10%. And when you hear that drop of about 10%, you have the correction. And the correction it happens on average every 2 years, so it's not uncommon. It's only a 10% drop, so it doesn't always signal fear, and people are not always as concerned when they hear correction. They're a lot more concerned when they hear a bear market. And what a bear market is, not a 10% drop, but a 20% drop. And again, in my lifetime since 1969, we have had 8 of those, which means that on average, it happens every 7 years. And this is where it gets interesting because when people hear bear market, well, that's scary. And because it doesn't happen as often, it also feels like, wow, we haven't seen one for a while, and that's bad. And that tends to heighten the sense of anxiety of being invested in the U.S. market. And that is legitimate. I mean, because again, these bear markets don't happen. They're not infrequent, but they don't happen every 2 years like a correction. It's basically on average every 7 years. But I also thought interesting, Steve, is that in my lifetime, there have been market downturns that are even greater than a bear market. And it made me think, what's greater than a bear market? It's
Hmm.
a grizzly bear market. That is a 30% drop. And those tend to be prolonged, and they tend to actually be very painful to investors. And in my lifetime, there have only been about 3 of these downturns. And please don't read much into it. On average, it happens every 18 years. And the last time that we had one of these was in 2008. So we're kind of coming on exactly 18 years, but averages mean nothing. If you put your feet in boiling water and your head is in the freezer, on average, you're comfortable. So don't
Yes.
read much into it. I mean, the first one was in 1973, and then it took 27 years until the next one came along. So it's not averages, not real, but it is important to kind of take a step back and say, every once in a while, the market does have these really steep, prolonged downturns, and acknowledge them before they come, and to know it's not unusual, it's not unprecedented. They do happen, and what can you do about it? Well, the first thing is you have to a little bit manage the expectations of how long they last. The first one that happened was during that financial crisis, the oil crisis that I talked about in 73, 74. And if you look at the US stock market, if you had invested $1 in December of 1972, the question is, well, how many months would have taken for you as an investor paying attention to the market on the news to recover the money and to break even, to go back to the same level of investment that he had in December of 1972? And the answer, Steve, is actually surprising to a lot of folks, but it took 91 months. 91 months that you keep looking at the news and it's still down, it's still down. It wasn't until July 31st of 1980 that it recovered. So it can be a very long time, very, very long time for the market to be under. Now, the question is, what can you do about it? Is there anything that he can do to shorten this and perhaps not have the steep drop? And to me, yes, there are 4 things that we believe that he can do. The first one is that when you invest, you have to acknowledge that when the market drops, instead of selling in panic, kind of go back to the same idea, keep investing even as the market's down. It sounds counterintuitive, but you can do it. And the simplest way to do this is not to take the dividends, which are the payments that companies make, and stash them away. But what if you simply reinvest the dividends, which are what part of the profits companies pay to you as a shareholder? And if you simply do that, what's amazing is that instead of 91 months, you would break even in 3.5 years. Half the time. Half the time you'd be back in black. So it's a really powerful thing not to get scared and spooked by the market, but continue to reinvest. And the simplest way to do it is reinvest the dividends. Now, What else can you do? Well, as I mentioned earlier, the S&P 500 represents large, well-established, mature U.S. companies, but they're also the smaller one. We talked about the smaller companies in the U.S. What if we add a proportion there? What if we look internationally? We talked about international investing and add some component to international stocks. And what if we balance everything with some bonds, which are a form of lending, and they have a very different dynamic than the stock market. And if you just create just a very basic, typical allocation, and yours is actually more sophisticated than this, but if you just simply look at a very basic allocation and you compare the results, what you see is that in 1973-74, it took 91 months to recover, and at the worst point, it was a drop of 46%. That was the biggest loss that you would have seen. If you did these four things, reinvest the dividends, put some money in small, international, and bonds, instead of 91 months, you would have cut that down to about 3 years. In 3 years, you're back in black. So it's so interesting that both the time to recovery and the magnitude of the loss, they are significantly better. So it turns out that you can actually do something about it. You cannot avoid the loss, but you can mitigate both the time to recovery and the maximum drawdown. The second of these grizzly bear markets was the dot-com bust, and Steve talked about that. And in that period, it took 81 months for the market to recover. And at the worst point, once again, it was 46% down. If you had implemented the strategy that we talked about, instead of 81 months, you would have been half of that, a little over 3 years. And at the worst point, it wasn't a 46% drawdown, but rather a 20% drawdown. So once again, a significant improved outcome if you use this strategy. And the latest one was the Great Financial Crisis, the GFC in 2008. And that took over 5 years, almost 5.5 years to recover. And at the worst point, it was 53% loss. So it was significant loss at the worst point. With this strategy, it would have been about 3 years or so before you're back in black, and the maximum drawdown was also smaller. So it is interesting that in every single one of these grizzly bear markets, what you see is that you might not be able to avoid loss, as I said, but what you can do is significantly improve both the time to recovery and the maximum drawdown by reinvesting dividends, by putting some money in small companies, international, and bonds, be fully diversified around the world, and ultimately have that plan. Because again, if you are closer to retirement or in retirement, no other assets, it's possible that you might have even more in bonds, and those time to recoveries and maximum drawdowns would be even shorter. Anyway, so that to me is more of a bit of a fire drill, just to remind people that if that happens, you've seen some of this data, and if you can remind yourself that I know this happened, and the markets have been resilient, and we don't need to panic too much. And again, I mean, over and over, I see this idea that people say, yeah, but it's different this time and all that. We've seen it. We've seen it. And even if you go to really bad case scenarios, before this my lifetime, and probably the worst in modern history in terms of geopolitical events, it was the World War II. And you can look at data even for that and see, what it means to be disciplined, and why you have to have confidence in the markets. Because if you go back to September of 39 and you see the bombs are falling and the war starting, and then you fast forward to the end of August 45, when the war ended, and you simply said, as an investor, I'm just going to stay disciplined. I'm not going to carry it away with emotions. What's amazing is that dollar invested at the beginning of the war would have pretty much doubled during 6 years of World War II. And obviously we got pulled into war in December of 41 with Pearl Harbor. But if you look at the full years of a U.S. engagement, in every single year, it went up.
Mm.
So anywhere you look, it's kind of amazing. And the story here is not that war is good for business. Not at all. War is terrible for business. But rather the more fundamental premise that gives me confidence, and I kind of talked about all this, which is ingenuity. That companies being resilient and trying to figure out, how do I navigate this time? And in the case of Michigan, I mean, I lived in Michigan, I lived in Lansing, and I had a lot of friends who worked in the auto business. And if you look at the auto business back in those days, when soldiers were fighting in Europe or Asia, they really didn't have much of a customer base at home. So what do these companies do? Well, if you Cadillac, you're going to take your engine and put it into a tank. There was a Cadillac tank. I'm not sure it had power windows and leather seats, but that's a Cadillac tank. Ford started making airplanes and selling them to the government. When you think about, build Ford tough, it's not the F-150. It's basically it's the tanks that they built during the war and sold to the government. And as you know, Jeep, it's a great company. A lot of manufacturing in the Midwest. It started as a company to sell vehicles to the army. So to me, it's this idea that the confidence that I have is in the resilience of companies. They'll figure it out, and even if they get through the grizzly bear markets, they'll work it out. They will figure out a way to navigate and make it work. And that's the beauty of free markets. As long as we operate in free markets, I have confidence in the markets, even as you might get the grizzly bear markets, or you might have some more. So that's the sort of like that's just a cautionary thing about markets, but also just very hopeful about the idea of free markets and participating in the ownership of these companies. And the last thing that I want to touch is exactly that idea of what is it that what's the benefit of working on advisors? And I think that to me, when I look at what advisors do, and I've known, as I said, I've been to your offices maybe 6 years ago, 7 years ago by now. What's interesting is that there's not one thing that advisors bring to the table, but rather it really ties into the needs that families have. And the first element of what I think advisors bring to the table is what I consider to be competence. And competence is cornerstone to what advisors bring to the table because they have experience, credentials, expertise with clients like you in areas such as creating a custom financial plan, which, as I said, is so hugely important. It could be in investment selection, what stocks, what mutual funds, ETFs we buy, but also investment monitoring, make sure that they do what they're supposed to do. It could be in creating an asset allocation. And also, we talked about rebalancing. It could be in estate planning. It could be in taxes. How do you generate income in retirement? How do you risk management? How do you manage the risk, insurance, and so forth? And all of these are competencies that advisors have that are fundamental to a successful investment experience. And then beyond competence, there's an element of coaching, which is education, like what we're doing right now. It's not a product pitch, but just to understand a little bit better how the world works. Making sure that you manage your emotions. We talk so much about that importance of controlling emotions and managing stress too. When things are stressful, you can call Steve and the team and get an answer. It could be in how do you spend and how you save. And it might just be, it's not all about save more and spend less. The other way, hey, get yourself a latte. You're doing okay. Having a trusted second opinion, is it smart to do this with my money? And in general, maybe maximizing well-being and not like on a race of how much money can I make, but how can I have the best life possible? So there's an element of competence of coaching. There's also an element of convenience, and convenience means that if you delegate, maybe you can do it yourself, but the fact that you give it to somebody who knows what they're doing, they're competent, that earns you some time savings. That's you can spend more things and more time with the what's important to you and your family. It's also great personalized service that you always have a quick and a correct response. It could be vendor management. What are the right vendors that are secure and safe and they good pricing, coordinated with other trusted professionals, and ultimately also what I think of as the elegance of simplicity, that all the pieces of your financial life in one easy to access place. But there's, Steve, one other element that I've seen over the time, and with your firm and with a lot of other advisory firms, boutique like yours, which is not just competence and coaching and convenience, but this idea of continuity. That quite often there's one individual in the family that handles money, and everybody else is on the outside. And knock on wood, and something happens. Like, who do you know? Where's the money? Who do I trust? And to me, it is really important to have spouse involvement, making sure that both spouses know not only what the money is, but they create some, joint financial goals that everybody knows what's available and what's feasible. There's also an element of getting the kids literacy in terms of money, and then getting them involved so they're not making costly mistakes with their money. Maybe multi-generational planning. In some cases, family values. Like, how do we pass not just money but family values? Could be philanthropy if you're looking to donate, or if you have enough money to create a legacy and a foundation. That's also important to many people. So, again, when I look at all of these activities of what Jim provides to you, it's not about a financial plan. It's not about investment selection, what stock, what ETF. It's much more fundamental. What I do believe that they ultimately provide is peace of mind. I work with somebody who knows what they're doing. I have a good relationship. They understand me, and I'm gonna be okay with my money. And I think that's the biggest thing that I found advisors provide to their clients: that peace of mind, knowing that we have a plan, and a plan is built to withstand times like this, and somebody who understands us as a family, what's important to us, and make sure that we can accomplish our goals.
Well, maybe we have time for one more quick question,
Absolutely.
and it should be an easy one. Um, what one belief must an investor have to stay disciplined for a lifetime?
Free markets. That's the easiest one. I mean,
Perfect.
you have to believe in free markets, because in free markets, companies and individuals will be ingenious, and that ingenuity translates in an individual being resilient. You're going to try to figure out how to go through hard times. It means that a company's resilient, which makes the markets resilient. So it's all about free markets, in my opinion. And as long as companies are allowed to innovate and be dynamic, that to me is the number one thing.
Well, Paul, I want to thank you for taking this hour to spend with us. I think it was really helpful at the beginning to separate the very real human impact of the war in Iran with the separate but important to us market impact, but not to forget that this is a human event. For helping us better understand tariffs, because that is a constant confusion, and how to treat AI in through investments. And I think what's going to stick with us all is how to thrive in a grizzly bear market. I don't think I've seen grizzly bear, but we were going to delve into that much more in upcoming meetings on how to thrive and treat those periods as an opportunity. Um, and then the value of advice. Thank you so much. Is there anything else you wanted to say as we close?
Well, thank you for the invitation to be part of this. I really appreciate it. It's been great fun talking to you. So look forward to visiting Michigan sometime
All right.
soon.
We'll see you soon. All right.
Bye bye.
Bye, Paul.